Why prepaying your home mortgage is almost always a terrible idea, says Ofer Ganel. This is Dayline about a year and a half ago. I think I actually read this a while back, and I'm going to read it again because it's interesting to me. I think I get this question a lot. Probably one of the top three questions is, should I pay off my mortgage? I disagree and I agree in some regards. So this is not just one of those boilerplate or rote, or you can get 8% in the market and you're only paying 3% on mortgage. No, it's more to it than that. It's actually a pretty good article, pretty good piece actually. And there's some parts in here I agree with just fundamentally. By and large, I disagree with it, but there's some parts of it I do agree and I want to address with you. So there's this fancy schmancy house right there. That's not where I live. But I like it. 3-car garage. Got some trees out back. Looks like it's on. That might be. I don't know where that is. Anyway. All right. So let's read on. If you follow such personal advice gurus as Susie Orman, Dave Ramsey, and others, you've heard them tell you repeatedly to pay down your mortgage as quickly as possible. Whether by making an extra payment each year or by adding extra money to each payment, they want you out of that debt as quickly as possible. Becoming debt-free as soon as possible is certainly a laudable goal, but with the very limited exceptions, their advice actually puts you at a higher risk of losing your home. Let's see why. So their advice actually puts you at a higher risk of losing your home. Let's see why that is. What happens when you pay more than your monthly mortgage payment? Say your home mortgage is the most common type, a 30-year fixed-rate loan. Each monthly payment first covers all the interest since your last payment, with the remainder reducing your principal just enough so that 30 years after you took out the loan is paid off in full. It's the bell curve thing. You're paying very little on your principal, and then you hit the precipice, and now you're paying very little on interest because you're paying mostly toward your principal. When you pay more than required, you reduce the principal faster than the original duration, and the loan is paid off faster. That seems like a good thing, right? So why is this such a terrible idea? To answer that, you have to understand that when you pay your principal down faster, you're not paying the next payment or a portion of it earlier. What you're doing is reducing the balance on which the interest is calculated. This means that the interest portion of all your following payments is slightly reduced, which slightly accelerates the rate at which the principal goes down. In effect, you're paying off your last few payments early. I completely agree with that, and I think it's important to understand. You're not reducing your monthly payment. You're actually paying off, instead of being 360 payments, you're going to have 340 or something like that, or 358. It doesn't change anything on your monthly payment, but it does say you have less monthly payments to pay, and you will pay less interest, guaranteed. And he talks about the good part of prepaying your mortgage. The reason why personal finance gurus want you to pay off your mortgage as soon as possible is twofold. First, and less important, is that it reduces your total interest costs over the life of the loan. Second, once your mortgage is paid off, there's no risk of losing your home because you can't make mortgage payments on time, i.e. if you lose your job or have a major medical expense. Why prepaying your mortgage doesn't save you that much money and may actually cost you money. While paying interest in general is not a particularly good thing, in the case of a mortgage, it's not that bad. And here's 3 reasons why. First, because a loan is secured by your home, the interest rate is lower than most other types of debt. Second, Uncle Sam picks up part of the interest tab through the mortgage interest rate deduction, assuming you itemize. If your marginal income tax rate is 30% and your annual percentage rate is 4%, the deduction reduces your taxes by about 1.2% of your interest payment, leaving you to cover the remaining 2.8%. Now, this was written in February 2018, but remember, only 8% of the people itemize right now, and the vast majority of the people who itemize anymore are wealthier people. So essentially, this is the mortgage interest deduction is a non-starter for the vast majority of people. I'm just telling you right now, don't let that dissuade you at all from paying off your mortgage. He talks about 3 reasons why paying off is not a good thing, because the loan is secured by your home, the interest rates are lower. I agree with that, what I'm saying. So if I have to pay between paying off my interest on my mortgage or paying off a credit card, I'm certainly paying off the credit card first. But we'll assume that's paid off. Well, paying down your principal is not a bad thing at all. And don't follow this advice on itemizing, because most people don't. But this one is pretty important right here. I've always thought this is important, and this is what I always think about when I'm prepaying my own. I pay about an extra $500 a month on my mortgage. This is one area that does interest me. Mortgages in the U.S. are not pegged to the CPI, inflation. So inflation eats away at the value of the dollars you pay, and more importantly, the dollars you still owe. Say inflation is 2% per year, that means the value of your loan principal drops by about 2% per year, which reduces your effective interest cost by that 2%. Completely agree with that. That's a concern of mine as when I think about it, it's like, gee, should you really pay it off in an inflationary environment? Look, it's not even have to be that inflationary. 3% means you're doubling the cost of living. I think it's every, 3%? It's going to double it every 25 years, I think. Well, let's take our trusty calculator. If we had it, 24 years. So if you had a 3% inflation, you're going to be doubling the cost of living in 24 years. So what that simply means is the amount you owe from an interest perspective will be reduced in half in 24 years. But don't forget, that interest perspective, it will be gone because in 24 years you're paying all principal. All right, now, but he makes a good point. I mean, at the end of the day, your house will be worth this much theoretically because it grows with a CPI and your principal payment is locked in. So essentially your principal payment is dropping in value in real dollars because inflation is eating it away. I agree with that. That's a challenge. I mean, the fact is, in inflationary markets, a fixed debt is bad. You don't want to own bonds in an inflationary market, and the bank owns the bond. Essentially, what they're doing, they're loaning you money at a fixed rate, and you're paying an interest rate, or you're paying with dollars that are losing value each and every year. So it's more advantageous for you to keep that debt. I agree with that. This is a conundrum. All right. What's more, if inflation runs high, your real interest costs might become negative, which means you're actually be making a net profit on your mortgage. That even without assuming any appreciation of the value of your home, you're making a net profit on your mortgage. That's one area I completely agree. There's a second area I agree with this too. How about doing away with the risk of losing your home? That too is not as advertised. Say you took out your mortgage 5 years ago and have been making an extra monthly payment each year. Your payoff debt has probably been accelerated by several years. Let's say now it's only 17 years away from being paid off instead of 25 because you've been making extra payments, one extra monthly payment each year. Since we're talking about the risk of losing your home, let's say you suddenly can't make your mortgage payments. Can you just call your friendly lender and ask her to recharacterize your earlier principal payments as if they were made in the next 5 months? That would push your payoff back to the original 25 years from now, but at least the bank won't foreclose for several months, by which time you may be able to make payments again. Unfortunately, if you try that, the lender will laugh in your face. That's not how it works. You're still required to make your monthly payment each month or the bank will foreclose. And again, so that's they're saying, look, you might have knocked off 3, 4, 5 years on the back end of your principal, but of your mortgage, but if your if your monthly payment is $2,000, you still got to come up with $2,000 a month. What you should do with the extra money instead of prepaying your mortgage. Let's say that instead of making extra payments against your mortgage principal, you invested that money conservatively. After making an extra month's payment each year for 5 years, you probably have at least 6 or 7 months worth of payments in your investment account. Now, if you lose your job, you could use that extra money to make payments for 6 or even 7 months, giving you the extra time you need to get back to your feet, on your feet. The best part is that if you never lose your home and continue investing in extra cash each year, you can still pay off your loan in full years early. Of course, that doesn't mean you should, but as mentioned, you might actually be making money off the darn thing. So who's this guy? Ofer? He set up. He set up several small businesses, including consulting practice, supporting NASA, government contractors. He's a physicist, systems engineer. So a couple of things: amateur photographer and artist. All right, well, yeah, man, I think that's good. I think that's a very good article, well thought out, as opposed to typical. If you got 8% in the market and you're only paying 3%, you're gaining 5% a year. That's not the argument to make. The argument to make is twofold, like this guy is saying. Inflation is eating away at your loan. That's for sure. That's tough for me, man. I'm telling you, it's tough for me because I'm sitting there thinking, I want to squirrel away as much money extra as I can into this debt because I like the idea of building equity and paying less interest. I just do, because the interest is enormous. And the more I reduce that interest, the better off I'll be financially in the long term. That's just a fact. But it is the long term. It is the long term. I won't see that benefit until 15, 17 years from now, like my man Ofer Ganel is saying. Second, I completely agree with the idea if you're prepaying your mortgage and you don't have a savings account and you get laid off, you're in a world of hurt. You are. I completely agree with that. And thirdly, and this is what I think about even mostly, is what if I don't ever recoup that equity? So let's just say I'm building an extra $6,000 a year equity because I'm paying $500 a month more on my mortgage than is due. So every year I'm paying $6,000 more than I need to. And let's just say there's a downturn in the market, just like a downturn in the stock market. And now I'm sitting there, 15 years, and I'm like, man, I thought I had $200,000 equity, but now I only have, 150,000. All that extra payments are for naught, where I could have had them someplace else. I don't know. I mean, that's a tough one, but I think about that too. Like, what if the market is only as good as what the market will allow? And if buyers don't want it, regardless of how much you pay down the mortgage, you're not going to get that money back necessarily. So anyway, I'm still paying off the mortgage just because I like the idea with cash flow paying off that debt. I do, and I'll continue to do it. It's kind of like, I don't know how to explain it. It's just, I hate the idea of a debt. I love the idea of not having a mortgage when I go to retirement. So I'm 62, I'm 49. When I'm 62, I fully intend to have no more debt. And that's a fact. All right. Anyways, good article. Good job, Ofer, and we'll see you guys next time. Thanks now.